Hello friends, we are going to start series on digital currencies. Under the topic, we will discuss about brief background of digital currencies, objectives and concern on its implementation. We will also discuss about retail and wholesale currencies and uses of digital currencies for international trade. In this video, we are going to talk about central bank digital currencies brief overview. We will come up with more videos on the subject to get deeper understanding. Before delving into details on our topic of central bank digital currencies, I would like to take you through the rise of private digital currencies, which are widely known as cryptocurrencies, and what are the threats posed by its wider acceptance. Nowadays, discussions on digital currencies are taking a center stage. With the rise of cryptocurrencies, investors are treating digital currencies as an asset class and would like to allocate some part of their investment portfolio to it. In fact, during the pandemic, investors were considering cryptos as an investment option, an alternative to gold. The rise of private digital currencies is also due to falling faith in the banking sector, especially after the 2008 crisis. Some people believe widely used developed market currencies value should be much lower than what is perceived. It is not reflecting their true economic health. Hence, they want to create a system which is decentralized and should be controlled by users rather by central banks. This has led to rise of digital currencies like Bitcoin. Private digital currencies sit at substantial odd to the historical concept of money. These are neither commodities nor claims on commodities as they have no intrinsic value. Growth in popularity and acceptance of private digital currencies has posed a threat to prevalent payment mechanism. Claiming the benefits of decentralization, cryptocurrencies are being hailed as innovation that would usher in decentralized finance and disrupt the traditional financial system. Since private digital currencies can be used as a conduit for money laundering and terrorism financing, governments and regulators across the globe are keeping close eyes on uses of these currencies. Further, private digital currencies can make monetary action by central banks ineffective and destabilize economies. In this section, we will discuss about how the implementation of CBDC will help in countering the threat posed by cryptocurrencies. We will also discuss about why there is urgent need for emerging economies to launch their own digital currency. CBDC, being a sovereign currency, hold unique advantages of central bank money like trust, safety, liquidity, settlement finality, and integrity. The key motivation for exploring the issuance of CBDC, among others, include reduction in operational cost involved in physical cash management, fostering financial inclusion, bringing resilience, efficiency, and innovation in payment system, adding efficiency to the settlement system, boosting innovation in cross-border payment space and providing public with uses that any private virtual currencies can provide without the associated risks. CBDC will provide the public with benefits of virtual currencies while ensuring consumer protection by avoiding the damaging social and economic consequences of private virtual currencies. In this era of digitalization, currencies of major economies will become even more dominant. Since private digital currencies are pegged to major economy currencies like stablecoin or valued in major economy currencies like Bitcoin, it will further strengthen the major currencies and weaken emerging market currencies, even for their domestic uses. Dominance of major economy currencies may result into transfer of capital out of country and will create dollarization of emerging economies, which would be harmful for them and their currency management. With the digitalization, convertibility and movement of funds would be much fast. Even it would be difficult for central banks to control and protect currency volatility, which will make monetary policy less effective. To protect monetary independence and to prevent dollarization of economies, emerging economies are embracing CBDC to make their payment mechanism efficient. Central banks across have realized these challenges and started pilot and research to embrace digital currencies. As per the Atlantic Council, 105 countries constituting 95% of world GDP are exploring CBDC. 10 countries have fully launched a digital currency with China's pilot set to expand in 2023. Jamaica is the latest country to launch a CBDC. Many countries are exploring alternative international payment systems. The trend is likely to accelerate following financial sanctions on Russia. Now we will discuss about importance of payment mechanisms. Payment systems are at core of the economic development. It supports financial stability and helps in financial inclusion. The endeavor of any central bank is to set up payment system which should be safe, secure, reliable, accessible, affordable, and efficient. Reserve Bank of India has taken a series of initiatives to make payment system efficient. It has introduced UPI in 2016. Presently, India is leading the world in digital payments. Why there is a need for alternative payment mechanism? With the technological advancements in recent years, discussions on digital currencies are taking center stage. These discussions are further fueled by falling faith in the present payment system where banks act as intermediaries. Historically, commercial banks have acted as an intermediary for payments. A bank deposit, which is convertible into cash, makes the current mode of settling transactions safe and attractive. It also provides stability as deposits are issued by banks under the license of the sovereign issuer of currency. This payment system is called an account-based payment system. This payment system runs settlement risk at the economy level. As given in the picture, under present payment system, during the day, bank settles transactions between interbank and customers. Banks manage daily liquidity management by executing borrowing and lending transactions in interbank money market. At the end of the day, all transactions settled with the central bank which complete the settlement cycle. Till all banks transactions are not settled with the central bank, settlement risks stay in the system. Further, the account-based payment system favors banks as they have created their own walled garden around payments which hinders entry of new payment players. This led to inefficiency, delay in payments and higher transaction cost. Now, technologies have transformed financial markets and intermediation activities. With the development of new technologies like machine learning and artificial intelligence and expansion of fintech and big tech companies in finance has accelerated digitalization of financial services. Adoption of digitalization is perceived to bring efficiency gains in payments and data processing. Hence, there is a need to look for alternative payment systems which are more agile and efficient. Now, let's understand what are the differences between money, currency, digital currency, and central bank digital currency. Money has an intrinsic value. It acts as a medium of exchange and to store value. Money can be in the form of commodities like gold, silver, etc., or in the form of debt instruments as currency. Hence, currency is essentially a debt instrument. It is a liability of the issuer and an asset for the holder of currency. In modern times, currencies are issued by central banks and it is a claim on the assets and resources of the country. Similar to physical currency, digital currency is a debt instrument issued in digital form. With advancement of technologies, private digital currencies are being issued and getting accepted by people despite having no underlying or credible issuer. Hence, it carries credit risk and its wider acceptance can destabilize the economic environment too. Since private digital currencies can be used as a conduit for money laundering and terrorism financing, governments and regulators across the globe are keeping a close eye on its uses. Further, private digital currencies can make monetary action by central banks ineffective and destabilize economies. A CBDC is a legal tender issued by central bank in digital form. It is similar to fiat currency in uses. In other words, CBDC is a sovereign currency issued digitally. Now let's understand what is the difference between digital payments and payments through digital currencies. Many people find it difficult to understand the difference between digital currencies and payment through UPI or digital wallet. When I speak with people, they believe Since UPI is there, then why there is a need for digital currencies as all transactions are happening digitally? Let's understand difference between these two. Digital payments are very wide connotation. It includes payment executed in electronic form, either online or offline. It also includes payment done through accounts, wallet, credit or debit card, or through digital currency. Whereas any payment executed using digital currencies are known as payment through digital currencies. When we are using UPI or digital wallet, we are actually using money created by banks, not a real money. However, when we will use digital currency, we are going to use real money. Digital currencies are not going to replace UPI or bank money. Rather, it will replace cash. Instead of carrying cash in physical wallet, we will be carrying cash in digital wallet. To conclude our discussion on brief overview of CBDC, CBDC is a legal tender issued by central bank similar to present fiat currencies but issued in digital form. It is backed by economic resources and strength of a country, unlike private digital currencies, also known as cryptocurrencies, which are speculative in nature. Further, CBDC will help to counter threat posed by cryptocurrencies. Moreover, implementation of CBDC will bring efficiencies in the payment system. It will foster financial inclusion and boost innovation in payment space. Most of central banks across the globe are piloting CBDC projects to harness the technology to develop future-ready payment systems. So here we will close our discussion on CBDC Part 1. We will shortly come up with Part 2 of the series titled Objectives and Concerns on Implementation of CBDC. Thank you for watching the video. Hope you like the video. If you have any suggestion and feedback, you can reach us at info@sahasacademy.com, or you can visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you.